So Canada's in a lot of debt. I believe we're the most indebted G7 country in the G7. And I came across this tweet today by the economic Longwave. And he has a chart here that shows Canada's household debt as a share of GDP. We're at 103%. Meanwhile, all the other countries are a lot lower than us. And this is a big concern for a lot of people for reasons that I'm going to cover right now. So this guy basically says Canada tops the global leaderboard for household debt relative to GDP, higher than the US, UK, and even debt-sensitive economies like South Korea and Australia. This ratio means households owe more than the entire annual output of the Canadian economy. What this means: debt saturation. At 103%, Canadians are highly leveraged. Any income shock like rising unemployment, interest rate hikes, or falling asset prices could trigger defaults, especially in real estate. 2. Consumption drag. High household debt crowds out future consumption. If income increasingly goes to debt servicing, it saps economic growth. Basically, if everybody's money every single month is going towards servicing the debt of their mortgages, well, there isn't a lot of money left for discretionary spending, like going out to restaurants, traveling, and all these other things that stimulate the economy. Maybe not so much traveling, but all that discretionary type of stuff that stimulates our economy here. People don't have any money for it because they're spending all their money servicing the debt of their mortgage, right? And 3, vulnerability to rate volatility. Unlike the US, where most mortgages are 30-year fixed, Canadian borrowers roll over mortgage debt every 2 to 5 years, exposing them to interest rate resets. And 4, he has real estate-driven fragility. Much of this debt is tied to overvalued real estate. If prices fall, as seen in the late stages of past Longwave autumns, negative equity becomes a systemic risk to banks and households alike. 5, the delusion of wealth. Phantom wealth from inflated home prices has masked stagnant real wage growth and declining productivity. Because people have equity, they can tap into that equity, or they'll go spend more money, like the wealth effect. People, if your stock portfolio goes up $100,000 in your mind, you're like, well, I can spend more money because I always have that $100,000 if I need to tap into it. Kind of the same thing that's been happening with Canadian real estate, right? So he says it's not prosperity, it's leverage. In the context of economic winter, Canada's 103% debt to GDP ratio fits the late autumn, early winter phase of the, no idea how to say that, Longwave cycle. So I checked this out. Yeah, I think it was this one I was looking at. So let me zoom into this. So basically it shows this theory. I think that's the name of the economist that came up with that kind of like every 30 to 40 years, there will be a longer macro frame boom and bust cycle. And if you look at it, I believe this is this supposed to be like the US? Maybe not. I don't know. But what I can tell you is if you were to look at it from like a Canadian sense, maybe our waves were at different time frames. And the last bottom that we had would have been the start of the 90s recession, which I believe would have been spring of 1990. And then maybe we started kind of rallying from there because we didn't really have a financial crisis here in Canada. Like home prices came down like 10%, unemployment went up, but it really wasn't that painful and didn't last very long, right? So maybe our wavelength or our waveform is a little bit different than what is being showcased in this picture. And maybe, the bottom actually started in the 90s. And if we went until 2026 or something like that, that'd be 36 years. And that would kind of be the bottom of that, wave cycle or whatever it is. Because if you look at all of these, that's 40 years long. That's 40 years long. That one is 50 years long, 50 years long. So it would be tough to say, like, if we bottomed out in 07, 09, well, why is this one only 15 years and all the other ones are 30 or 40 years long? That kind of invalidate this theory, in my opinion. But if you're taking the bottom of that, not from the 07, 09 crisis and from the early 90s, then this could make sense that maybe the next time this cycle bottoms out would be from like 2025 to 2028 type of thing. And that would kind of line up with the typical time frame given in this theory. So back to this, he says, as social mood shifts from leveraging to deleveraging, this kind of household debt burden becomes unsustainable. Defaults rise, asset prices fall, and the illusion of middle-class wealth is shattered. Bottom line, Canada's high household debt to GDP ratio is not just a red flag, it's a siren. Compared to nations like Germany at 52% or France at 63%, Canada's overexposure suggests a coming reckoning. It's not a question of if deleveraging will happen, but how painful it will be. So I have thoughts on this. Again, not an economist, not a very smart guy, but I kind of just make these videos to have a discussion about it, right? So how does deleveraging like actually happen, right? Because people think that, oh, if people can't take their, pay their mortgages in the bank, we'll just foreclose, take it back, and then that's deleveraged. Not necessarily, because somebody else still has to buy that house from the bank. And the next person who buys it is likely going to use leverage, right? So how it actually happens is, let's say you have somebody who buys a house for $1 million and it goes down 20% and they sell it at 800 grand, right? Well, the next person who buys it for 800 grand won't have an $800,000 mortgage. They'll have like a $620,000 mortgage. So if that happens a whole bunch, then people essentially deleverage. And that is happening in real time right now. This could also happen over a much longer time frame, where like kind of what's happening right now, where like transaction volumes are really low in Ontario and BC. And all the new transactions are kind of happening in like Calgary, Winnipeg, Edmonton, and all the cheaper markets. So like, those markets are sucking what would be buyers out of expensive real estate into cheaper real estate. And then over a long enough time frame, if like the overall sentiment changes from, I want to own investment real estate, I want to keep my mortgage, and it just changes to, no, I just want to pay down my mortgage, which probably would have been the case if rates were still around 5%. But you could see this start to go down just from people paying down the principals of the mortgages they already have and not upgrading their homes and not buying investment properties. So you could technically deleverage over a much longer time frame. And again, I'm just thinking out loud here. I'm not fully well-versed, entrenched into the Canadian economy and all these things, but these are just some things that I saw this and I thought about, well, how do you deleverage, right? Like, does the market just crash 30% and then all of the new buyers that take on those properties now are buying them at a lower purchase price, therefore there's less leverage? Or can you actually do it over a longer time frame where, the overall sentiment of people in Canada changes and they don't want to own as much real estate, they don't want to be as leveraged, they actually want to pay down their mortgages and they're making those mortgage payments every month? And then over the course of 5, 6, 7, 8 years, maybe you can slowly deleverage just by like the overall sentiment of the people living there changing. I would say that this like Canadian real estate probably has a very big, has probably contributed a lot to our GDP per capita falling. Like obviously there's a million things. We haven't like unlocked natural resources and all this kind of stuff too. But if everybody, like I think 90% of people's income on average in Vancouver goes towards servicing their mortgage, right? That's probably not healthy for an economy, right? And it's kind of been like this for a long time. It used to be 30% of people's income would go towards debt servicing. And then I remember for a while it was 70%. And then I recently saw a chart where it was like 93% or something like that. So I would agree with most of this, that is probably a very large contributing factor to GDP per capita falling, because there just isn't as much consumption because everybody's just paying their ridiculous mortgages. And I would agree that we do need to deleverage, but the question is, how does that look, right? Like people, always want a sharp drop, 30, 40% down. They get a reset. Everything is instantaneously better. But I'm of the belief that, markets have a weird way of causing max pain in almost every scenario. I mean, just look at what happened with the stock market, right? Like the stock market tanked. That was super painful. But even on the way back up, it was super painful because the S&P went to like basically all-time highs. And there was record levels of cash on the sidelines from hedge funds because everybody was too scared to buy back in. And then everything just kept rocketing upwards and upwards. So somehow, even in that scenario, even though it was like a V-shaped correction, it still caused max pain. You had a whole bunch of people who lost money on the down, and you have a whole bunch of people who were underinvested on the way up. And I think a more painful scenario than like a sharp correction in 30%, a more painful scenario would just be that this gets drawn out super long over the course of like a decade. And, that's why they say, just rip off the Band-Aid, right? Why do you rip off the Band-Aid? Because if you rip off the Band-Aid, it's less painful than slowly pulling off the Band-Aid, right? But maybe I'm wrong. Just some thoughts I had on this today. And if you enjoyed the video, please like and subscribe. And if you want to chat with me about buying or selling real estate in the Fraser Valley, link down in the description to my calendar. Otherwise, I'm that Agent Kelly. I'm making moves to move you. Peace.